Hello, everyone, and welcome to BFW 2401, Week 5, Bank Capital Planning. Now, in this week, we will talk about the capital planning from the private perspective, which means from the perspective of the management of the bank, not from the perspective of the regulator. And therefore, we will talk about something called target capital. So briefly, I have divided this lecture into four parts. So the first part, we will just define this capital and measure it. And when we come to the definition, we will talk, of course, about the regulatory definition. Then in the second part, which is the core actually of this week, is to talk about the target capital. And in number 3, we will go and see if when we know what is our target capital, which means how much capital we should have as a percentage to the total assets, we will start now looking where we can get this capital. Of course, our assets will growing and our capital should grow. Now, when our asset is growing and we need more capital because it's proportional, then in this case, we want to know where to get that capital. We have two areas. Either we get it from the retained earning or we call it from the internal sources. And here there is some calculations. And this will be part 3. And part 4 is actually talking about the external sources. As you can see, it's a story and it's a nice story. And I think we can do it fast. So in the first part, I have around 20 slides. If you allow me to share, I think I will go over it very fast. Now, this is the first issue we are talking about. And you can see I'm bringing this map again for the purpose of telling you that we are talking about the capital risk, which is capital planning, but actually one would wonder what's the difference between capital risk and this capital which we talk here, which is what you call the capital adequacy. This is the regulator perspective, which we will take it in week 11. It's a long walk, a big walk. And this is what we are talking about, the target capital and all these issues. So just to show you where we are and what is the difference between this one and how it fits in our learning objectives. Now, let's talk about the learning objectives here. We want to define the capital. There is 2 approaches, as I told you. We want to know the regulatory definition and the simple ratio definition. And then we will outline the bank capital planning in relation to selecting the target capital and achieving that target capital, where to get it. And we will, at the end, we will have 2 models. This is actually a measures of how we can and plan to get capital from inside the bank. And we will talk about 2 models, as I told you, the internal generating, internal ICGR, which is internal generating capital ratio. And there is another model called asset growth model. Now, this is the references, but I think the slides will be okay with the tutorial and the workshop. But if you can access this book, I think this is the better place to reflect what we are talking about here. Now, this is the capital planning part 1. So as you see, we will define the capital. Now, defining the capital, someone would say, we already defined it so many times. Yes, but the thing that you will know today is that there is 2 definitions. Before we measure it, we want to define it. This is A, which is the simple definition, which we understand. The capital is just the difference between the total assets and the total liabilities, which means the difference between book value of the assets and liabilities. And we know that, and we know its components is the issued shares and any reserves and any profit we didn't distribute, or we call it the retained earning. This keeps accumulating and increasing the capital. And this is actually when we started our IPO and we started with our shares or other, issues. After that, this is the issued shares, and then this is what comes from the profit, and also the reserves that we accumulate as we progress in time and operate. Now, what is the function of the bank capital? Now, this function is different because the function of corporate is what? Is to buy raw materials and to pay for what we call the establishment expenses, the fixed assets, and operating capital, and all of those is actually for the operations. Now, for us, the function of the capital is in banking is it's a long-term funding, and this is not really the most important thing. But also when we have capital and enough capital, we demonstrate to the shareholders, commitment. And this is why in this country, for example, they asked for 1 billion ringgit. Why? Because the shareholders who established the bank are actually paying from their pockets $1 billion or 1 billion ringgit, and this is really a commitment. Now, with that, when we have enough capital, we support also the confidence to the market and ensure that management is exposed to market discipline. This is very interesting, which means now when we have less capital, the market will start punishing us by giving us more risk and decreasing our price, because the price is actually related to the risk, because it's the cash flow over the risk. So when we have less capital, of course, we perceived to have capital risk, and therefore our share price will go down. And when they invest with us or when they deposit with us, they may ask for more returns. So this is when we say it supports the confidence and ensure. So when we have enough capital, our outsiders actually are confident, and we are not exposed, to this risk of market discipline, which means punishing us for not having enough capital. And then, of course, this is the main thing, which is I need the capital mainly to buffer my losses when it happens. Now, I think I have talked about this, which is actually the buffering issue. It's the same thing. You have the internal risk, which is all of those risks, which we keep talking about it. You already, know it. We have talked so many times about it. We have defined so many of them. This created risk is coming in this area, and in this area, of course, we will have all those management inside all those systems, and controls and corporate governance inside the bank to prevent this risk or to decrease it, like the policies of credit policy, the policies of liquidity, the policies of trading. All of this is so many policies, and all this to decrease the risk. But sometimes we cannot actually decrease the risk, so it will go the capital, and this is the function of the capital when we say it's a buffer. When we say here, it's a buffer. This is what we mean by the buffer, and I think you already know that. Now, this is just to explain what I just said here, which means for a given system of management, management and control, more capital means a lower probability of insolvency and safer bank. We understand that because it buffers any losses and it doesn't take us to bankruptcy. Now, this is the interesting point, which is the regulatory definition, which I think it's a new for you. What is it? Regulatory definition, which is different from this definition, which is the equity. Equity, we know it's just the difference between the assets and liabilities. But those guys are talking about something else. They are talking about we need a capital that have the following characteristics. One, to provide permanent and restricted commitment of funds, which means if I participate with my capital in some type of bonds, for example, I participate 5% or 3% or 4% for this long investment of 30 years, now I can use the capital money instead of using the money of the the depositors, because it's risky, because this is the shareholders and they can be patient and they don't have claims against us unless we go bankrupt. Be freely available to absorb losses, which means this is the most important thing. We need a capital that doesn't pay, sorry, that doesn't pay, is available to use it anytime to buffer the losses, which means it's all the time it's there available. And actually, it doesn't pay services, which means now the loans, if I'm financing my assets from debt, I have a service fee, I have servicing. Servicing means this interest which I pay. But here, I'm not paying for the shareholders. Yes, I'm paying dividends, but when I decide to pay dividends, if I say no, that's okay. If I say a management and the board say no dividends, or there is no profits, no. But here, it's a fixed servicing fee. You take a loan or you take a debt, then in this case, there is that part of interest. If you default, you are bankrupt. Here, if I say no dividends, no problem. And finally, it ranks behind the claims of depositors and other creditors in the event of winding up. So when we close the bank, when we wind it up, or we liquidate the bank, we will pay all the people, all the creditors, all the depositors. Whatever is left, we will distribute it among the shareholders. So if that capital, as you can see, it looks like equity capital. It looks like equity capital. And this is actually the essential capital. And the regulators actually focus on that capital, which seems like the equity capital. Do we have any other capitals? Yes, we call it tier capital. So the tier capital part of it is the equity capital, this one. But it has other parts, which is less quality. Now, what we call the top quality is the equity, fine, which is actually, if you take this condition, it applies to it. The second one, ordinary shares, which is the equity. The second one is the preference shares. But the preference shares, we pay dividends, actually. And when we pay dividends for them, and that dividends is fixed, so I can pay 6%. And they have to pay it. It's like a debt. They don't have voting rights. We understand the preference shares, and they are different from the common shares. They are just, we pay them, we call it dividends, but it's a fixed dividends every year. Now, this type of preference shares are two types. One of them called cumulative, and the other one called non-cumulative. The non-cumulative is part one of tier one. Why it is part of tier one, which means higher quality, better quality than the cumulative one. Why? Because if the preference shares, for example, are supposed to receive 6% annual dividends, and we didn't pay this year dividends, that 6% is not going to forward to next year. So next year, I'm not going to pay 12%. And if I don't pay next year, then I am not going to pay the third year 18%. So in this case, we are talking actually of something close to equity, Okay, so and this is why we make it tier one. Now, the capital, which we have, as I told you, tier one and tier two. And both of them, tier one and tier two, represent what we call the total capital. Maybe this is a new concept for you. So we have ordinary shares, and number one, non-cumulative. And the third one is the retained earning. And I think most of you in accounting, retained earning is just that part of the profit that I don't distribute it to the shareholders. What is left after we pay the dividends, it is a retained earning, and it becomes part of the capital and join that pool. Now, we have also general reserves. Any reserve we take from our expenses and for income for any different type. We have so many reserves. Those reserves actually is part of tier one. And actually we have the last one, which is specially approved hybrid. Now, don't worry about this specially approved because it's approved by the regulator. We are talking about the hybrid securities. Hybrid securities, it's a debt. It's actually a debt that can be transferred to equity, which means if the bank, which is taking this debt, decided to make it equity, then it will be an equity. which means now they cannot actually ask me to pay that debt. I can pay it if I'm willing to, but if I'm not willing, I can transfer it to a type of equity. And this is what make it actually part of tier 1. Now, somebody would say, so what about tier 2? Tier 2 is the following. We have something called supplementary capital, which is tier 2. Now, you can look, while I'm talking now, see whether the quality, whether when I say quality, whether it actually reflects those characteristics, which means whether I can use it, whether it's available to use it. If you look to supplementary capital, which is tier 2, it's less. It's less, it has less accessibility. So we have the first one is mandatory convertible notes. Mandatory convertible note is a bond issued by a company which must be converted into shares to common stock on or before a specific date. This is actually because there is a specific date and all these issues, we make it like a mandatory, it's a it becomes part of tier 2. So there is a specific date, which is different from the hybrid securities. Now, the other thing, it's asset reevaluation reserves. And this is very interesting. And those people in accounting know. For example, if take any bank here, say, for example, Public Bank. Now, Public Bank started in 1965. In 1965, maybe they bought a big land here in Klang Valley. For international students, Klang Valley is the biggest part here in Selangor. Now, which includes Kuala Lumpur, of course. So that land, that time, maybe equals 1 million ringgit, and 1 million ringgit is too much. Now, I want to sell this land now, maybe it's huge land, maybe it's 200 to 300 million ringgit, or maybe already have a billion. So in my books, it's still 1 million. If I come and reevaluate that land or that building, which I acquired in 1965, I will have 290. For example, if I sell it for 300 million, if the price, I didn't sell it, I just reevaluate it, and it's 299 million, the difference, because I sell it down for 300 million and it was in my books for 1 million, that 299 million is a reserve, reevaluation reserves. As you can see, it's not really a capital. Yes, it will be part of my capital, and I will show it in my balance sheet, it's a capital. But actually, if I want to access that capital, I have to sell the building, maybe of the head office. And this is a different issue. And then we have some other general reserve for credit losses, like this provision for credit risk and for losses, for bad loans. So those ones, actually, we accumulate them expecting that somebody will come in the future, will default, and then we have to pay. But it is not actually happened yet. So that type is actually part of the capital, but because it's part of the capital and it is reserved for some contingent, it's type of contingencies that will happen in the future. So in this case, we may use it in the future, but actually it's part of our capital, and regulators allow us to use it as part of tier 2. So a reserve that against future presently unidentified losses like credit risk, whether for individuals or for group exposure, and also the past dues, where any amount due under contract, interest, principal, whatever, this is actually part of the general reserve for credit risk, which is part of tier 2. And number 3, our friend, which is the cumulative. Now, I already explained what is the non-cumulative, which is tier 1, which is in tier 1, cumulative, non-cumulative preferred shares. This one, which I don't have to pay, this one is different. It is a preference shares, but if I don't pay this year, 6%, I have to pay next year, 16, 12, third year, 18. So actually it becomes like a debt. It is, we call it preference shares, but actually it becomes like a debt because it just forwarded those commitments, which means there is a commitment for it. And finally, we have subordinated debt. Now, subordinated debt is any type of loan that is paid after all other corporate debts and loans. So if we participated with any company as capital, and then that our participation or investment from capital in the other companies is actually will be paid for us after all debtors are paid. So actually we are like the people who are receiving the residual value. That actually is still capital, but still under the subordinated debt. So having said that, this is actually the tier 1 and tier 2, and the definition of the capital, definition of the regulatory capital, and definition of the simple ratio. And maybe this is one of the new things that you may know in this time. So to conclude now, tier 1 capital is the focus of capital planning, and we want this capital to be always there. And actually, it looks like equity capital, as I explained it to you. Regulators, even very suspicious, and not really very suspicious, are not very, their concentration also not with the tier 1 capital, but also with tier 1 and the equity capital. Okay, this is a summary. You want to use it, fine. You don't want to use it, fine. But it will give you the picture. So we talk about the equity capital. We talk about the regulatory definition. We talk about the risk. We talk about tier 1. We talk about tier 2. And we talk about all those risks. So all of these issues actually has explained. This is just a summary of those slides I have talked about. Let's go now to the measuring of the capital. And this is just a piece of cake. So we have 4 measures. We have gearing ratio, leverage multiplier. I think you already know this from week 4. And we have the simple capital ratio, which we know it, everybody know it, even in accounting, equity capital over total assets. And we have this the regulatory definition, which is tier 1 plus tier 2 over the total weighted. So if you have this balance sheet and you want to calculate the capital according to those 4 ratios, you can calculate all of them, except for this one, because I don't know what is the risk-weighted assets. There is nothing here about the risk-weighted assets. So I will calculate the gearing ratio to be 90 over 13 times. This one to be 14 times, this one to be 7%, and this one I don't know because I didn't know the. So as you can see, when the capital is and as the denominator, an increase in this in 1 and 2 implies increased capital risk, which means if this is less, and this is becoming 14 times, 15 times, 16 times, which means my capital is getting smaller and smaller and smaller comparing to the total asset. Here, the gearing ratio over the liabilities. When it becomes smaller to the liability, it's also increased target capital. But when my capital is actually the denominator and it increases, this percentage are likely to increase. So that is actually decreasing capital risk. When it increases here and here, it decreases capital risk simply because our capital is increasing. Here, our capital is decreasing. It's as simple as this. I'm done for this part. Thank you very much. I will not waste your time, and I will stop this, and I will see you on the second part. Thank you. Bye-bye.